Good morning to all of you, and welcome to this session of Strategic Financial Management. In our last session, we were discussing regarding financial procedures and system, and also some part of the role of financial managers in an organization. And we had already discussed regarding who is a financial manager and what roles does he or she plays in an organization? And the first one among that was raising of funds. We had discussed what are the steps taken by a financial manager in raising of funds, and why does taking all those steps are necessary for the survival of an organization. And also we were discussing regarding the funds allocation function of a financial manager. So we had discussed, let us try to briefly discuss it once again. Now, here, when we are speaking regarding the role of financial manager, especially we are trying to understand in terms of how the role of financial manager in an organization used to be in the traditional approach and how it has changed in the contemporary world, and as a result of this, how has the scope of financial management widened. Now, speaking about funds allocation, it goes without telling that the traditional approach, outlived its utility in the changed business scenario, particularly after 1950s. And it was the result of a number of changes in economic and environmental factors, like maybe the increasing speed of industrialization, technological innovations, inventions, and also the intense competition, the intervention of government in the business, and also some of the very big failures of business organization, and mainly due to population growth and widened markets. Now, all this resulted in the effective and efficient utilization of firms' resources, not only firms' financial resources, but also all the resources that a business organization had at its disposal. Now, the development of a number of management skills on the one hand, and also decision making techniques on the other hand, facilitated what we call as the implementation of or a system of optimum allocation of firms' resources. And as the result of this, it could be the approaches or it could be the scope of financial management also changed. And this has changed, or the importance had shifted from episodic finance to financial management. That is to tell, the importance had shifted from raising of funds to efficient and effective use of funds. Okay. And to support or to explain how it has changed, uh, we had discussed a quote from Ezra Solomon. I would tell it once again. I quote Ezra Solomon: "In this broader view, the central issue of financial policy is the wise use of funds, and the central process involved is a rational matching of advantages of potential uses against the cost of alternative potential sources so as to achieve the broad financial goals which an enterprise sets for itself. Unquote. And from this, we can know that in a modern enterprise, the basic finance function is to decide mainly about the expenditure decision and thereby determine what is the demand for capital for all these expenditures to be covered. We can also tell this in the words that the financial manager in his new role or in her new role or this contemporary role is always concerned with the efficient allocation of funds. Now, the allocation of funds is not at all and never is a new problem. However, it did exist in the past, but back then it was not considered important enough in achieving the firm's long run objective. Now, we are telling that the financial manager's role has changed. So, it becomes necessary to understand that in this new role of using the fund wisely, a financial manager must be always able to answer some of the questions in the most rational way possible. The questions that are to be answered are: the first one is, how large should an enterprise be? Maybe in terms of the value of the firm, maybe in terms of the sales they are doing, maybe in terms of the changes they would be bringing for the economic system. And along with that, they should also decide prior regarding how fast the growth be of their organization. The second question that is to be answered is, what is the form in which the organization is going to hold its assets? Will it be in the form of fixed? If it is fixed, in what kind of fixed assets? Or is it going to be current asset? Now, this decision definitely depends upon the type of the business and also size and nature of the business. There are no any standard rules regarding how much should be invested in the fixed assets. It depends upon organization to organization and changes from one company to another. Now, the third question that is to be answered is, now that you know how much assets is necessary or how much funds is necessary, you will have to decide as a manager how should these funds required to be raised. What are the ways in which you are going to bring in funds for the organization? Now, as we discussed earlier, all these three questions that we discussed, if we clearly observe, they relate to three broad decision making areas of financial management. Investment decision being the first one, which would be including both the long term and short term assets, and it is financing and dividend. Now, the modern financial manager has to help the organization to make this decision. Not only make this decision, but the decision that are to be taken should be made in the most rational way possible. That is to tell, these decisions are to be made in such a way that the funds of the firm are used to the most optimum possible. Now, these these decisions are being said as the functions or the decisions that are to be taken by a financial manager, because they always require special care and extraordinary managerial ability. Now, as we used to discuss earlier, the financial decision will always have a great impact on all other business activities. That is to tell, our organization is not only concerned about the finance aspect, but it is one of the most important and would be present in all other activities. So, this particular decision will always impact other business activities also. So, the concern of the financial manager, besides his traditional function of raising money, now will become and has become on determining the size and technology of the firm, and also in setting the pace and direction of the growth, and never to forget that it would be present in shaping the profitability and risk complexion of the firm by selecting the best asset mix and also financial mix. Hope whatever we discussed until now was clear and easy to understand. Moving forward, the next role of financial manager is profit planning. Now, speaking about this, the functions of the financial manager may always be widened and includes profit planning function. Speaking about profit refers to all the operating decisions in the areas like pricing, cost, volume of output, and also in selection of firm's product lines. Therefore, when it comes to practical sense, profit planning is therefore regarded as a prerequisite for optimizing investment and financial decision. Now, this profit, when we are deciding on the profit planning, we should always try and we should always know the cost structure of the firm. Now, speaking about the cost structure. Now, cost structure is the mix of two kinds of cost. First one being fixed cost, second one being variable cost. Okay. Now, fixed cost refers to all those costs which remains fixed. To give an example, maybe the rent of the building, the payment of the insurance, or as such. The variable costs are those costs which would vary with every unit of production. Maybe electricity, maybe water bill. Now, speaking about electricity and water, they are not entirely variable. They are semi-fixed or semi-variable cost. Up until certain point, no matter you use either electricity or water, you use it or not, you will have to pay a fixed portion. That is fixed portion, and above that whatever you use, maybe in terms of unit or in terms of liters, you will have to pay the charges based on how much is being used. Now, fixed cost refers to all those costs which will not change with the number of output which is going to be produced by the company. You either produce a zero product or you produce to the most possible way, that is to tell the maximum number of output. Fixed cost is going to remain fixed for a certain time period. Now, variable cost usually changes with the changes in number of output being produced. That is to tell, variable cost usually involves the cost of raw materials and the labor that is being used in producing the product. And also, we should remember one more important thing, that is, the total fixed cost will always remain fixed, whereas the fixed cost for each produced output will be changing with the number of production, and variable cost will always remain fixed for each product that is being produced, but the total variable cost changes with the number of the products being produced. And it is always that because of the fixed cost, the profits fluctuates at a high degree than that of fluctuations in sale. Now, the changes in profit due to changes in sale is what we call as operating leverage. Earlier session we had discussed what do we mean by financial leverage. Now we are trying to discuss what do we mean by operating leverage. The fluctuation in the profits due to the changes in the sales is referred as operating leverage. Now, even this particular concept you'll have to study in detail and in the coming chapter separately. Now, this profit planning helps to anticipate the relationship between the volume, costs, and profits of an organization, and thereby develop action plans to face the unexpected surprises of business environment. Moving forward, one more role of the financial manager in his daily business is that he should understand the capital market very well. Now, capital market is that place which brings both the investors and the firms, or in other words, the lenders and the borrowers together. Hence, being a financial manager, he will always have to deal with capital market. He or she should always fully understand what are the operations of capital market, and also they should know how the capital market values the securities. They should also know what is the and how much risk is measured and how to cope with the investing and financing decision of the organization. To make it understand in a easy way, understanding the financial market or understanding the investor becomes necessary because a company might go for you know go for funding its organization using excessive debt finance, or in other words to tell, the capital structure would be made only of the debt. Okay, when a company does this, there are chances that investors might think investing in such a company which is only using debt as for its capital structure would be very, very risky, because their perception is that it is because people are not having any kind of investment opportunities. That's why they are not investing on the equity capital, and as a result, the company is raising funds through debt. Now, the value of the firm's share, because of this perception of the investors, may decline, and similarly the investors may not like sometimes to invest in the high profitable or growing firm because of the declaration of dividend. And they also might like that sometimes, instead of declaring all the profit in the form of dividend, that the company should reinvest profits in attractive opportunities that would result in increasing or making high capital gains in the coming future. And it is also necessary to understand that every investment involves risk and return, and it is through the operations of the investments in capital markets that the investors continuously evaluate the actions of a financial manager. So, by far we had understood what are the functions of finance, what are the role of financial management, the different terms that are being used or being a financial manager. Let us now try to understand in a very, very brief manner what are the functions of financial management. Now, each one is different. Do not get confused. As soon as you would be given with your study material, do try to understand by reading it once. Okay. Now, the first function that could be mentioned as the function of financial management is that it always estimates the requirement or the capital requirement of business. Now, a financial manager firstly always has to make the estimation regarding what would be the overall capital requirement of the business. Now, it is not at all an easy task to estimate. It will always depend on several determinants. Now, to mention the determinants, it could be, the probable cost and expected profits, and also upcoming programs and policies of the company. Now, though it is not an easy task, predictions have to be always made in adequate and concerned manner, which would result in increasing the earning capacity of the business on one hand, and also which ensures the proper use of financial resources on the other hand. Thus, or by doing all this work, financial management always functions as a guide to financial manager in estimating the capital requirement of organization. Moving forward, the second function of financial management is that it ascertains capital composition. That is to tell, it tries to make a point wherein it tells how much capital is necessary. And when it tells how much capital, it also tells what are the different kinds of the capital that is to be involved in the business. Now, once the financial manager estimates the capital requirement, a financial manager has to take effort in knowing the capital structure of the company. Now, this particular decision or this particular work always involves the analysis of both short-term and long-term debt and also equity. Now, this will always depend upon the proportion of the possession of equity capital a company is already having, and also the other different kinds of additional funds which it has at its disposal or which have to be raised from outside parties or from third parties through borrowings. Once after this is done, the third function is it makes the choice of sources of funds. Now, as we discussed earlier, a financial manager always needs to evaluate different sources of funds. For that matter, any business organization will always have many choices for raising additional funds. It could be in the form of loans that can be taken from banks and other financial institutions, or issue of company shares and debentures, or also public deposits which could be drawn in the form of bonds. Now, choice of factors will always depend upon the relative advantages and disadvantage of each source, and we should always remember that it is not only source but also financing period is also very, very important. The next one is investment of total funds. Now, the financial manager has to decide how will he allocate the funds that he has collected in the profitable ventures or avenues. Now, the financial manager will have to make sure that there is safety on investment, and there will always be positive and regular returns possible on all this investment. And the capital should be invested in a wisely manner so that there is least possibility of losing fund or acquiring losses. Now, for these reasons, the manager can use different tools of financial management, like maybe profit portfolio analysis, net present value, internal rate of return, average rate of return, and other tools and techniques for analyzing or deciding in taking decisions based on investment. The next one is disposal of surplus. Now, a financial manager calculates the profits of the business at the end of accounting period, and this is a mandatory work that has to be done. Now, once after having a net profit, the decision has to be taken by financial manager of the company. Now, as we discussed, it could be made in two ways. Either the dividend can be declared, or it can be retained and used in purposes like expansion, diversification, or innovation of the business. Now, the next function of financial management is it manages the cash flow. Now, the financial manager of a company has to make a decision regarding cash management. Now, cash is required for all the purposes like payment of wages and salaries to the employees or workers, payment to the creditors, payment of all other expenses like electricity bill, water bills, and also in meeting current liabilities of the business. Now, cost of maintenance of having enough stock, purchase of raw materials for daily production is also necessary. So, thereby the financial management helps in managing the cash flow. The next one is it controls the finance. Now, the functions of a financial manager not only financial plan, procure fund and utilize the fund, but he should always have the knowledge as to how to control this finance which is being used in the business. Now, to help doing this, the financial management provides the financial manager with different tools like ratio analysis, forecasting of finance, cost analysis, and control and profit distribution techniques. And mentioning regarding the functions of the financial management, the next one could be the decisions that are to be made regarding acquisition and merger. A business organization can always has its choice that it can either be expanded through acquiring other business, by entering into new business, by the way of mergers with other firms. Now, while acquisition decision denotes a process of purchasing new or existing companies, the merger will always be in a process where two or more companies join together in the form of a new business. Now, during all these decisions to be made, a financial manager has to deal with many complex valuations, like maybe the valuation of the share, the valuation of the security of each of the companies that is going in for merger and also acquisition. Now, I understand maybe it is merger and acquisition, maybe the business environment, maybe all these topics are there in all the three subjects, different subjects that you are having in your syllabus. It is present in your entrepreneurship and small business enterprise. It is there in international business environment. It is also there in your strategic financial management. Now, the meaning of the things would remain the same, but the perspective or the viewpoint of an entrepreneur would be different. The perspective of a financial manager regarding the merger and acquisition is different, and also the perception of these things when we go for international business would be different from one another. So you'll have to know for which subject you are trying to explain, because the viewpoint of the entrepreneur would be very, very different for the perspective or viewpoint of financial manager. So it is never a repetition. The things are to be understood in each of the different subject the way that it is to be understood. Now, moving forward, the next function is tax planning and protection of assets. Now, it is duty of financial manager that he should always try to lessen the tax liability of the business. Now, this task should be performed very, very wisely, because it involves too much of complications. Now, it is very important that a financial executive should properly examine the various schemes and also invest accordingly. He should always protect the assets engaged in the business to ensure the best use of these resources. And one among the many finance functions that are there that we can mention is that it helps in decision on capital budgeting. Now, long-term decisions will always involve investing in shares or bond, and also purchasing new equipment, building new plant, etc. Now, these decisions are simply called as capital budgeting. Now, in this decision making of the company, a financial manager will always face many complicated situations, as all these processes requires a huge amount of capital. Now, it is necessary that a financial manager identifies the investment opportunities and the involved challenges or the risk. Now, the efficient use of financial management functions will always help a financial manager and also the company to maximize its wealth. Therefore, a financial manager or the financial management is a continuous and also a interrelated process which always involves the identifying the required amount of funds or capital that is necessary for running the business continuously and also promptly. It also involves evaluating and selecting the best sources of funds and also allocating the funds according to the need of business, and also the distributing of earned profit. So now this was all about your financial management, the terms that are that are used in understanding what is a financial management, why is it important to understand financial management, what are the roles that a financial manager plays. So let us now move forward into one more different aspect of the financial management, where we would be in detail discuss regarding the objectives of financial management. Now, studying strategic financial management or being a financial manager, it is very important to clearly understand what are the objectives of financial management or what is the financial goal. Usually it is to, one is profit maximization and the other one is wealth maximization. We'll have to try to understand what is profit maximization and what do we mean by shareholders wealth maximization. And by the end of the discussion, we'll have to decide on whether profit maximization is better off for an organization, or is it that the wealth maximization is better for an organization. Each one involves different decisions that are to be made from the side of the organization. Could it be the profit maximization? Could it be the wealth maximization? Each of this has its own advantages, and also we try to understand what are the disadvantages that are being present in both. Now, it could be the investment decision or it could be the financial decision. Now, this both the decisions of the firm regarding investment and finance are always unavoidable and also continuous. Therefore, the organization has only one choice of making these decisions rational as possible. And to make it rational, the company should always have a goal. Now, it is always agreed or generally agreed in terms of theory that the financial goal of a firm should always be shareholders' wealth maximization, or what we call as SWM. Now, this is also being reflected in the market value of the firm's share. Now, we shall try to discuss wherein we can try to tell that wealth maximization is theoretically logical and also operationally feasible normative goal for guiding the decision or the financial decision making. Now, whenever we try to tell the objective, we tell it in the context that the financial management is used to describe a goal or a decision criteria for financial management decision. Now, for financial management, an operationally useful criteria is nothing but A decision that you take is to be such that which can be operated. It is not that it is the best decision only on the paper, but at the same time it should be equally operatable. So let us stop at this point of time, and after 5 minutes rejoin to the meeting. I will send you the link and we shall discuss it there.